Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, January 12th, 2026. It's 1:49 p.m. Eastern Time, so I'm starting the video. And this is video number 2, and I did the other one earlier. Then I had lunch plans I had to run out. I was going to post that one as is. I was letting it upload, and remembered that I forgot to cover, as I said I would, the market leading Magnificent 10 or whatever stock. So I'm going to do that. And then I'm just going to post them separately. That way, by the time you get this post, you'll have the first video and then this one covering the market leaders. Because in that first one, I was talking about if you're going to trade, actively trade the indexes, especially as they ping pong around in this trading range. You want to, either don't do it. If trading's not conducive, there are times that many days I don't make any trades, and there's days that I'm making a dozen or more trades, even just on sometimes a dozen or more on NQ alone or RTY or whatever I'm trading. I'm going to add a trend line here as I'm doing this before I move on. I already covered this. This is now we have a trend line here I should have had before right there, which is also a support slash target level. It would take us back down if we reverse today, by the end of the day or tomorrow or soon. Again, you can see we have resistance a little higher. This is probably what we're going to do today. Come up to about 629. That's the first decent resistance. You have one, two, three reaction highs recently right there. You've got a couple gaps in there as well. And so run up there, come on down. It would give us, that was, I think I told you about a 1.3% drop before. So we're a hair higher, take the same level, be about the same, a little more, maybe 1.5. And then if that breaks, that has more significant, pretty much what I'd say longer term consequences. At least, take us down to probably that 610 area there if that happens. So now let's look at the market leading stocks, because as I often say, an index or a sector is simply a sum of its parts. And to be more specific or accurate, in the NASDAQ 100 or S&P 500, it is a sum of a weighted sum of its parts, or a sum of its weighted parts, if I said that right. You know what I mean. In other words, we don't have to look at all 100 stocks in the NASDAQ 100, just the top 10. So let's do that right now. We'll look at a couple time frames. We don't need to at this point go out to the weekly, because this analysis is really short-term stuff. So there's Nvidia. Nvidia has been locked in a trading range going back for, gosh, coming on 9 months or more. Back to early July, we entered that trading range. There was one breakout above it. It proved to be a failed breakout. We re-entered the range. We went back down to the bottom of the range. We bounced, and that's it. So as I've said, these trading ranges, my analogy is it's energy building like a coiled spring. And whichever direction, a downside direction, obviously an upside direction in itself is bullish unless that fails. We already had one failed breakout. I can tell you it won't change the technical posture. In other words, I'll say it clearly, it's not a breakout that I would chase. Now, that it's not one that I would short either. The only way you short it is if the breakout fails. I think it would have, again, same pattern. It would, most likely, not guaranteed, have a minimal upside. And because of the technical posture, the divergences, overbought conditions likely fail. Now, this, to me, the fact we already had the failed breakout, I think the most likely scenarios would go down. And then when you go above, it's all blue skies, no overhead resistance on a stock with all-time highs. But down below, you have really nice price support. Again, this is this 165-ish level has defined the bottom of that range since early July. And you have the key 200-day moving averages. That's my red and blue line, exponential moving averages below. That's more intermediate term analysis I'm giving you there, guys. So shorter term, we're just coming off the top of the channel. So again, as I often say, when you recognize a trading range, the MO is to sell longs at the top of the range and or short. And then you cover down on the bottom or the midpoint. Quite often you get reactions when you're below it. It acts as resistance when below and support when from above. So if and when we take out the midpoint in the range, it's going to increase the odds we're going to go to the bottom of the range. And again, because that range is getting pretty long in the tooth now, here was a range last time, and you can see which way this one resolved, just like the stock market resolved to the downside. We bounced back, hit that midpoint line that I had drawn there, and then that was it. And from that point, it was a drop of about 38%. We were short. We were short before the deep seat gap. You guys remember that? We were short based on this right here, the breakdown and back test for that bearish engulfing candle. We had like a lot of trades, multiple entries all in this area here, and it was a very profitable trade. And this one, along with the market, very specified, cover all shorts, including NVIDIA. Talked about that down at the time on the April lows there, and go long. All right, so that's what to look for. A more intermediate term in the coming days to weeks, maybe even months. Either of those levels, the upside break or the downside break. I addressed both. This is a 60-minute chart. So this is again the realm of the swing trader. I'm going to take that line there that should go like this. I don't know if you can see my chart. So that was a divergent high. So was that. So that was the first shot across the bow. DH1 little drop. Second divergent high, bigger drop. Might not look like much, but again, if you're an active trader, that was an 11% drop. It ended with a little divergent low right there. You can see positive divergence. And again, watch, rinse, repeat stuff. So an investor in NVIDIA since literally last July has gone nowhere. They went up a little. They were feeling good. Then went down a little, and they're right back to about where we were in late July, early August of 2025. Again, so everyone will analyze that or look at that through their own lens. In other words, those bullish wanting to make a case to be long or buy NVIDIA will say the stock refuses to go down. It's taken a healthy consolidation, got a little ahead of itself. And glass half empty folks will say, well, it refuses to go up. We have a failed breakout. But again, we're going to just analyze this on a shorter term perspective now. 60-minute divergent high correction, divergent low rally, divergent high correction. That was more of a blow-offish top. Oh, it was actually divergent high. We had roughly an equal high. It was ever so slightly lower, but you had the negative divergence right there on that. And all I can tell you right now, and that's the point of this video, is where we're at today. But yes, I do look back. That's why I go back in time. Technical analysis is all about recognizing certain similarities, chart patterns, developments, and extrapolating or analyzing that and what happened to the stock or the market or whatever you're analyzing in the past. That's where technical analysis evolved. Some folks, long before I came around, started noticing certain patterns in the market that the market and certain stocks and indexes would do certain things, set up in certain patterns, and then act a different way or a certain way afterwards. And so that's what we're doing here. And again, it's not an exact science. It's not perfect, but it's the only way to actively trade. So there's our divergent low 60-minute chart. We rallied, and this is the first divergent high right here. There's your divergence point, started from there to there. Since this one, and that was the previous, and that one there. So again, history doesn't repeat, but it often rhymes. And we're coming off there. We recently took that level out. That was support. You can see we're dancing on 186.34. It was also resistance back here. We broke above it, successfully tested it. Then we broke down recently. We hit my first, you can see the first support level I have here. It was about 183.89. And we're now back testing it from above. So coming off that divergent high. And again, typically that drop we've had so far, it could be all we need to work off, to let that divergence play out. But it's only about a 5% drop. And historically, you get it usually much more than that, usually double that or better. Oh, by the way, it is also this. This is an uptrend line right here. We broke that trend line. We back tested here, got rejected. We back tested again, got rejected a little more. Back test, back test. So we've been back testing this trend line as well. That's resistance also. So that would be, again, a case can be made to short once you have a sell signal, especially coming off a divergent high. If the charts indicate there may be a bigger move, then you can treat this as a counter trend rally. So that helps to support the case I said in the previous video, following the recent breakdowns and sell signals on QQQ, to support a case in the NASDAQ 100, because this is still and has been for quite a while now the largest component, meaning it has the highest weighting on the index. So if you cannot make a decent case to be short or long NVIDIA, you shouldn't be short or long the NASDAQ 100, in my opinion, unless you can make a very strong case that the next 8 or 9 are all aligned with your trade on the QQQ or NQs. All right, we'll just stick to the 60-minute charts and dailies here. Here's Google, or aka Alphabet. This is Class A shares. Nice clean uptrend line in which to trigger a sell signal. I don't need to say much more. I believe I already have an alert there, but this will significantly increase the odds the market's going to go lower if and when that breaks. It's fairly well defined. What I'm doing here is highlighting all the reactions. There's 4 so far, 5, 6 distinct separate reactions on that uptrend line. It comes off the mid-August lows right there. We had a divergent high here. We had a sell signal on that minor trend line break. It was a small trend line, took us back to this trend line. And this marginal new high is still simply an extension of the existing divergences. That's my box tool, but you can see here that have been building now for quite some time. And those divergences also show through on this daily chart, which I just toggled out to here. Big divergences indicating, and there's a even more significant trend line. Is it the same one? Would I tell you that one? This one goes back to the, here, I'll color it up. Let's make it nice and fat. This is the one to watch. And again, it's probably the same one I gave you on the 60. Set alert right there. Lots of nice clean reactions on it. A beautiful setup in my opinion, right? Okay, so that's it. Take that divergent high, marginal new, still divergent. Major sell signal. 2 takeaways. Again, I'm going to go through the rest of the charts. I already made a case to be short, as an active trader. The Qs, since last week, really those sell signals are to re-enter now, re-short if you missed it. But then this is a daily chart. If you get this sell signal, that helps to support a case for a trade, a drop that's probably going to be measured in weeks, at least many days, possibly months or more, and also measured probably into the double digits, better than a 10% drop. In other words, it would align with what I've been telling you since last week or recently. This was a short trade here with multiple entries back here. We hit my first target. We bounced as expected. And this is T2, so the next drop should take us down there. We're not going here, in my opinion, unless Alphabet takes this line out. If and when it does, in my opinion, once again, that would increase the odds we're going to go down, whether it's on a breakdown and a back test. Sometimes you break down, back test, and sometimes you break down and never look back, right? All right, next up, Apple. We've managed to avoid that stop by the skin of our teeth, but it never gave us that weekly close above that level there. We hit my first target. Looks to be bear flagging right now. A bear flag is it's a continuation pattern. It will consist of 3 components. We'll look at it on the 60-minute chart here. You had a divergent high and a sell signal there. Flagpole consists of the bear flag, consists of a flagpole, which is an impulsive move down on increased volume. My volume's down here. You might not be able to see it, but it was. Followed by an area of a bounce, a relatively weak bounce on declining volume, which we just certainly have, that takes the form of a flag like that, upward sloping. And then to get the measured target, you take the flagpole, which is the move where that impulsive drop started, down to the bottom of the flag. That's this trend line here. And then I simply place it at the top of the flag before it breaks down. Now this flag hasn't broken down. So a sell signal comes on a break. You want to see it impulsive. Then you want to see volume pick back up. And typically these things, if they're going to play out, they play out in a similar fashion. In other words, the move is roughly equally as impulsive, pretty swift move down. That would take Apple down here to this 241 target, which would also be a drop of about 8% in Apple. If Apple drops 8%, folks, I can't give you my word or guarantee, but I can tell you very likely the stock market is going down with it, including the NASDAQ 100 and S&P. All right, next up, we're on the 60-minute chart. Microsoft's been locked in this trading range right here. Ping-ponging there. Downside break's going to be bearish. There's my first target on the 60-minute chart. It's minor. I'll tell you, it's probably going to want to run down. Let me give another level here. That is not the horizontal line I wanted. Big old gap here. This is a gap so big a blind man can see it. You can drive a truck through that gap. Hasn't been backfilled or tested yet, so that would be a drop of, well, let's just measure from right now. The bottom of the trading range, not much further. That's a 10.5% drop. So again, you can roughly quantify what that would do to the NASDAQ 100. Remember, all these stocks are highly correlated. They tend to go up and down, give or take, especially not so much in a single day, but over a period of a week, 2 weeks. Most of these guys will move in line with the NASDAQ 100. And there's the bottom of the gap there. So let's just say for kicks and giggles here that the gap is entered, it gets backfilled. That's down to 397. That's going to be a 16% drop. Yes, it can go the other way. If you're bullish, you want to see an upside break of the range, especially one that doesn't fail. But based on the technical posture, this is long building divergence that's started to play out, just like an Apple. It's finally started to play out. There's your daily chart. Microsoft, one of the leaders, peaked back here on a double top high with negative divergence. And it's been flirting with the 200 days, mostly on the downside below. It hasn't clearly taken them out. So what I want to see, if what I just showed you on the 60 plays out, if we break down from this is that trading range, then it's going to start to move you away from the 200s. And a lot of traders like myself, both professionals, individuals, are going to note that another one of the market leading most important stocks out there has lost 200-day support. The last time Microsoft lost the 200s was right here, and I implore you to, go back on your own charts and go ahead and just take a look at how well a lot of these tech stocks perform. Bull trends are above the 200s. Once they take the 200s, you want to get out of your longs and or start shorting. You short rallies back to the 200s, and when the 200s are recovered, long and strong again. Right? Successfully tested, lost. From the point they were lost here, the stock fell another 20%. Remember, that's off the high. And so there we are again, flirting with the 200s. All right. Amazon, bearish rising wedge, 60-minute chart, negative divergence. It's also going to come in a break of that. On the daily, it's I can really update these levels here. That's just one big divergent high that's been building back here since this point. Let me just connect the lines here. What I had here, it's a series. We had a divergent high there. Beautiful little wedge pattern. Broke down, was good for a trade. Again, this is swing trading. Sell signal there. Stock from that divergent high fell 34%. And then for all the reasons stated at the time, cover all shorts, April lows, and we're back here. And this is just, again, an extension of that previous high as far as the divergences. All right, so that's it. We need to, it's a minor trend line. It's not super well defined, but I think it'll do the trick. It's starting to crack, by the way. Meta. Meta, let's look at the daily, what I have circled here. Meta is another one of the big market leaders. It's lost its 200s. It actually lost them back here. That was following that divergent high. Got bigger, bigger, bigger. Then the sell signal came on the trend line break. Then it took out the 200s, and it has been back testing them from below and starting to move away from them. So this one is a check mark in my book. There's your support level that needs to go on the shorter term. About 637, a little bit above that. You can see nice support there. So if you are interested in, if you're a bull, buy pullbacks to this level if you think it's going to hold and rally. If you're a bear, you can either wait for a short of that level or add to an existing short. In other words, if and as each of these market-leading Mag 10 stocks that I'm covering, triggers these next sell signals, support levels, it just increases the odds. That's all. I play everything in odds. And right now, I put the odds on, it's a strong trend. They seem to be buying every dip. Let's just say from the sell signals I gave you last week and the objective short entries here for, let's just say a 10% correction or drop down to T2. Let's say my next target on the daily chart. I'd say odds are probably 65%, maybe north of that. They're favorable, but not super high. We start triggering these sell signals on these 60-minute charts and daily charts on the market leaders that haven't broke down. Assume those like Meta that are above their or below their 200 days remain below their 200 days. Then the odds jump up to 80, well north of 80%, in my opinion. All right, almost done. Got two more here. Broadcom, let's start on the daily. Broadcom, you can see here, this is a big level. I have it in yellow, about 324.39. Again, everything, not everything, but a lot of things, indexes, key stocks have been in these multi-month trading ranges going back to last fall. And a lot of them had similar failed breakouts, new highs. Again, as predicted, new high that occurs with negative divergences and overbought conditions has a much higher rate of failing. And a new high in itself isn't a reason to short. If anything, it's a reason to go long if you think it's going to stick. Reasons to short are trend line breaks, like that little uptrend line there, or a failure back down, a failed breakout. And so now, as is often the case, it shot us right back down, straight shot to the bottom of the trading range. Really nice support. And that's it. So there's the big level to go, 324.39-ish. You want to set an alert there. Been right now in the shorter term, it's been testing that 50-day moving average, that yellow line. So pop above there might bring it up. 60-minute chart. You also have some price resistance-ish. It's a little sloppy. I could put one more line here, and I'm going to do that because I can see, I see reactions really about right here. Of course, that one's pretty obvious. There's a gap there, reaction high, some reaction highs there, reaction highs there, support right there. So there's your levels. That's about 361. But this is also support level here. This is the top of the recent. It's been resistance more recently, and yeah, there's some gaps in there, another reaction highs, another gap right there. So that's it. And so there's the big level again, about 325. That defines the bottom of that recent trading range. That should certainly get things going. And guys, there's a lot of hot air. I know there's a lot of bullishness. I haven't gotten back to comments. I reviewed some. We've got our usual. There's one market cheerleader that always comes out on anytime the market makes new highs. They go dark only when the market makes new highs. All the reasons why it's just going to keep going up. And that's a very contrarian indicator. If you go back and look at that post, and sometimes it's one or two others too, that's usually when the top is in or very near. So there's a support right there to 311.50, a big old gap. So that if that goes, that's also very bearish as well. So even just to correct back, let's say Broadcom wants to backfill this huge gap back here. That's going to take, from where we're at now, a drop of about 11.5%. So see how these numbers are lining up? It's not coincidental when I'm looking at some of the big support levels, even if we just have a little correction. Again, I've made the case in the previous video. You trade, get 1%, 2% here and there on the futures. And if you're doing it as an active trader, use leverage. Leverage again it can kill you if you don't know what you're doing. But way I use it, and a lot of times I'm at full leverage during the day. I'll have a core, positions, commodities, stocks, bonds, individual stocks, long, short. That's the swing trade portfolio. And again, it depends at the time. Sometimes I'm a lot more cash. But lately, the market, as I said, has been a stock picker's market. So I actually have been spread out into more positions than I usually am. There are times where I'll concentrate on mainly trading the indexes when the market's coming off a nice big divergent low, oversold, like the April 6 lows where I said full long position. Then it's easy to just load up on the futures and not have to, sometimes I'll pick some individual stocks there. But in a bifurcated market, when we have some sectors doing well, some doing poorly, some stocks doing really good, some doing really bad, then you need that long short portfolio, and it starts to burn up capital. But that's where leverage is okay if you have where you don't want to. Let me just say this in a nutshell. unless you have the highest degree of confidence in the world, and even then you don't want to have 100% leveraged up portfolio, fully long, fully short any one thing, any one stock, or even it could be 100 stocks, but if they're all long and they're all tech stocks or the equities as a whole, you're not diversified. So by having that long and short positions, different sectors, different asset classes, stocks, bonds, commodities, crypto, again, long, short, depending on whether they're bullish or bearish. And then that gives you those days where, okay, I'll sit tight, market's grinding around, let my positions do their thing. You have your OCO orders for your swing trades, your stock positions, meaning OCO is one cancels the other. You have a stop loss on your longs and a sell limit order at your price targets. Set it, forget it. One of the two will be hit. And then when there's these opportunities, like I showed you in the previous video, to get those quick trades on the futures or whatever it is you're trading, be it natural gas, then you can use the leverage for that, and you're using it not in that very aggressive high risk manner if you're putting everything. And I say that because I can just tell I've been doing this a long time. I think people load up on one thing: semis, gold, silver, natural gas. And you do that, you're going to be either very, very happy or very, very unhappy if it goes against you. So diversify, diversify, diversify. So there's Broadcom. There's your big levels. I just added another one up here. Probably should be down here. If we rally up, there's a gap, resistance, and this is more of a resistance zone right there. Yeah, so that's it. Set alerts. This is the big level right here, give or take about 325. All right, one more to go, and that would be Tesla. Tesla looking better than the rest, at least on the 60 right here, coming off a divergent low. However, it's currently at down trend line resistance. As I often say, and it bears repeating, resistance is resistance unless taken out. So if it pops it and it sticks, great. I'm going to give you a price resistance level. I see right above it, about 459.40. It's a small divergent low, so far a small rally. However, this is a much bigger divergent high. That was DH1, divergent high 1, drop. Divergent high 2 right here, bigger drop. Ended with a divergent low, gave us that third rally, and it has been extending this divergence since right here. That's the mid-September. And when you see divergence that spans several months on the 60-minute chart, again, these little 60-minute divergent lows are... This is, as I tell you guys, this is my go-to swing trading time frame. You can get in here, get 4 or 5 on a stock, on a 60-minute chart, on a stock like Tesla. Typically, these trends are double digits. That's 30% there. That last drop so far, the stock dropped 15. From this divergent high, the stock fell 20. So you get the point. You have to, every stock, every index is different. I'm going to take this blue trend line. I'm going to borrow that or retask it, actually, is what I'm going to do. And I'm going to put it here. There it is. Nice. All right. I like that better. That's the early April lows right there. I'm going to fatten that trend line up, and I'm going to set alert. More significant implications when this line breaks versus a little minor trend line like that, or even that one, because it's longer term and pretty well defined. So let's set our price alert there. Oops. Nope. That's not what I did. Click set alert. All right, that's it. And just to be complete, go back to the daily chart. It's looks like a mess. I have so many annotations, but it's the same story. That was a divergent high. I pointed out that I gave you an official trade then. I gave you a total of 6 targets. We had first, second, third, fourth, fifth, and then I canceled T6 because I covered all lows, all shorts, and went hard long on April 6th lows. So that truncated all those trades. For the reasons stated at the time. And then it's just been a very swing tradable stock, but the trends are very big. They're oversized. You don't need a large position in Tesla. It's kind of like trading Bitcoin or natural gas. Drop off that bearish rising wedge breakdown. Then we took out the downtrend line, went up there. That's it. This is the divergence that's been building. There was our sell signal on that minor trend line. This is the more significant primary uptrend line right there. Okay, let me wrap this video up. And then what I'll do is I'll post it with the other one I put out earlier today. And we'll go from there. And I'll try to get back to any questions as soon as I get a chance here. I've still been catching up. This morning had me dealing with the web hosting company for a while, trying to get those the bugs on the site fixed, which so far seems to be working fine. This has been Randy Finney with Right Side of the Chart. Have a great day.